Greeting to everyone. Today's lecture is on the stock exchange. Every newspapers and TV channels publishes trend of stock market movements. There are dedicated media businesses tracking every events in the stock exchange. The national and world economic recessions points in history for the 1929 and 2008 as Great Depression and are marked by the dates of stock market meltdown. The stock market is an important indicator of the confidence in the economy. Let's start with simple question. Which of these three activities, that is poker, roulette and stock market investing, represent pure gambling? Which of these three activities represent intelligent speculation? Of these three activities mentioned, only roulette is pure gambling, while both poker and stock market investing are games of speculation. The difference between gambling and speculation is very simple. Gambling involves pure chance without any specific skill set, while speculation activity including poker and stock market trading requires knowledge. In the stock market, chance of winning depends a lot on the knowledge of finance and underlying business principles. The chances of getting good return on the stocks of ICICI Bank, ITC, TCS, etc. depends on the knowledge of financial principles and underlying business activities of those companies. Just imagine if there are no marketplace to buy and sell the goods and services, including daily necessity items. Further, if someone have money and want to invest in company shares without any facility of stock exchange. Also, what if the corporation wants to raise money by issuing shares for expansion outside stock exchange? The stock exchange is very similar to other marketplace, consisting of buyer and sellers, providing means for exchanging the financial securities. The subject experts are Dr. Sarvesh Kumar, Assistant Professor, Department of Marketing and Supply Chain Management, School of Business and Management Studies, Central University of Himachal Pradesh, and Mr. Santosh Kumar, who worked as a Vice President in Yes Bank Limited, New Delhi, India. He has also worked as Associate in SEBI, India. I am Shivangi Anand. In this lecture, we'll be covering the basic definition of stock exchange, its brief history, followed by process of investing in stock exchange. Then, we will learn about its stakeholders and functions and its importance in the modern economic world, along with some related topics. Introduction. A stock exchange, also called bourses, is a market exchange where buyer and seller can buy and sell stocks, also called shares or bonds or other financial assets, which are collectively called securities. It is an organized marketplace, often working as continuous auction place where traders and brokers consummate the transactions of financial securities. Market participants include individual investors and institutional investors such as mutual funds, banks, insurance companies, hedge funds, and listed corporations. Further, the stock exchange provides facilities for redemption of financial securities and payment of income and dividends. The financial securities are listed and traded on the stock exchange issued by the corporations or mutual fund organizations. Stock exchange is basically a physical place or virtual place where financial securities are bought and sold. London Stock Exchange, that is LSE, established by East India Company in the 18th century, is one of the oldest stock exchanges. The largest stock exchange by market capitalization in the world are New York Stock Exchange, that is NYSE, and Nasdaq Stock Market, that is NASDAQ. London Stock Exchange, that is LSE, Frankfurt Stock Exchange, Singapore Stock Exchange, Shanghai Stock Exchange, Hong Kong Stock Exchanges. Stock Exchange in India. India has two major stock exchanges, that is Bombay Stock Exchange, that is BSE, and National Stock Exchange, that is NSE. There are many regional stock exchanges including Delhi Stock Exchange, Kolkata Stock Exchange, Pune Stock Exchange, etc. Let's look at the evolution of two major stock exchanges, that is BSE and NSE. Bombay Stock Exchange, that is BSE. BSE, located in Dalal Street, Mumbai, is the first stock exchange in Asia established in 1875. It became the first stock exchange recognized by Government of India in 1957. In 1986, it developed BSE Sensex to measure the performance of the market. Historically, the exchange was an open outcry trading exchange for auctioning the stock. In 1995, the stock exchange switched to the electronic stock exchange for trading of securities. During 2000 and 2003, the exchange started trading of future contracts and derivative securities. Presently, the exchange has more than 4,000 publicly listed companies. National Stock Exchange, that is NSE. NSE, established in 1992, is one of the major stock exchanges located in Mumbai, that is in India. It was established by leading financial institutions and banks. NSE launched electronic screen-based trading in 1994 and derivatives trading and internet trading in 2000. The exchange has more than 4,000 publicly listed companies. NSE's flagship index is the Nifty 50, measuring major 50 company stocks to track the movement of stock exchange. Ownership of stock exchange. The stock exchange originated as a mutual organization owned by member stockbrokers. During modern times, the stock exchanges are now working as corporations with shares of the corporation listed on other stock exchanges and traded publicly. The stock exchange are an important indicator of the strength of economy. Hence, the market regulator appointed by the government have significant participation in the functioning of the stock exchange. Corporations. A corporation, which is the form of most large businesses and increasingly of small ones, begins when the state issues a charter to a group of promoters. Today, a single person may form a corporation, but normally it is a group. The owners or shareholders contribute money, property or services for shares of ownership. Shares of larger companies are traded on stock markets, while shares of smaller corporations are held by a few individuals or a single person. Shareholders elect a board of directors which hires employees. After salaries and other expenses are paid, the profits may be distributed to the shareholders in the form of dividends or reinvested in the corporation to allow it to grow. The corporation insulates the owners from liability. Stocks. There's no doubt that investing in the stock market can be one of the most exciting ways of making money. Nothing quite compares with the thrill of seeing the little-known stock you picked become a hot property, perhaps doubling in price and then doubling again and again. But as with any investment, the potential risks are equal to the rewards. So, investors who want to play the market owe it to themselves to become fully informed before getting involved. Advantages and disadvantages of stocks. Like any investment, stocks have distinct advantages and disadvantages. Advantages. Growth potential. When a company has the potential for growth in value and earnings, so does its stock. If you pick the right stock or group of stocks, you can profit significantly and relatively quickly. History shows that as a whole, the stock market has had an upward trend in values, with years of gain outnumbering those of decline by better than 3 to 1. Liquidity. Stocks traded on the major exchanges can be bought and sold quickly and easily at readily ascertainable prices. Possible tax benefits. Growth stocks, which pay low or no dividends so that the company profits can be reinvested, provide an effective tax shelter. As the corporation's value grows, so does the value of the stock, which is a form of tax-deferred income, since no taxes need to be paid on these gains until the stock is sold. Disadvantages. Risk. There can be no guarantee of making money by investing in stocks. Companies may fail, stock prices may drop, and you may lose your investment. Remember the saying of one concerned investor: I'm not so concerned with the return on my investment as I am with the return of my investment. Brokerage commissions. Most investors need the help and advice of a stockbroker when they become involved in the market. However, high broker commissions can largely erode profits. Since one fee is charged when you buy the stocks and another when you sell them, you are in fact forced to pay twice. Unusually, well-informed investors should look into the use of a discount broker who provides little or no investment counseling but charges greatly reduced commissions when trading stocks. Complexity. The stock market is complicated and the amount of knowledge needed to be consistently successful is tremendous. Investors who lack the patience, time, or skill to inform themselves about the market often buy and sell on impulse, thereby minimizing their profits and maximizing their losses. Individual investment in stock market. All you need to do is to open a trading account with any of the service providers like ICICI Securities, Angel Broking, IIFL, etc. They charge some annual maintenance charges for the account and brokerage commission for each transaction based on the product offering. The low commission fee percentage are provided for higher trading value. How can an investor place an order after opening the account? The investor needs to put sufficient money in the account, and then the person can place order by selecting the stock or ETF to be purchased and providing the number of securities to be purchased. Further, the order placement process asks user to select either market order or limit order. Here is the brief description of types of order for buying stocks. Market order. With the market order, the stock is purchased at whatever the share price being traded at the moment of order entry. The benefit of market order is that the order is guaranteed to be converted into transaction. However, the price can be swing very fast during the trade, and hence it can result in more than expected price of the stock. Limit order. The limit order provides user to set the upper limit of the stock price. This method provides to control the price to be paid in the stock, but it may result in the transaction failure if the actual price doesn't reach below or equal to the limit provided by the user. Participation in stock exchange. As the name suggests, the most obvious answer is through investing in stocks. Stock is financial asset actually representing tiny shares of ownership in a company. If you buy a share of Tata Motors, you will become owner along with many others of the Tata Motors company, amounting up to the value of the share. Once you own the share, you can be entitled to dividends and you can get the opportunity to attend shareholders meetings. Also, you can get some time to participate in company decisions through voting process. Participants in the stock market try to get good return of their investment. The investment in stock exchange is by two means. One is through dividend announced by the company and another by the price appreciation of the share. So, if someone invests ₹100 at the beginning of the year, if the company declares dividend of ₹5 and the stock price becomes ₹105 at the end of year, then the total return to the investor is ₹10. Another way to participating in the stock market is by investing in trading instrument called Exchange Traded Funds, that is ETF. It is simply a bundle of specific set of company stocks or specific sector stocks. So, the investor can invest in specific sector or the overall market index by investing in ETF, rather than investing in individual stocks, thus reducing the risk in specific company. Roles of stock exchange. The stock exchange play a very important role in the economy. Following are some of them. Raising capital for business. No economy can survive without businesses, and every business needs capital for operations. The companies raise money from public by issuing shares in the stock exchange through initial public offering, that is IPO. Mobilizing saving for investments. When the saving of an individual from the income is invested in stock market during share issuance, it provides capital to the companies for expansion and other corporate use. Thus, it helps to increase business activities, resulting in better economic growth and higher productivity level of the firm. Profit or loss sharing. When every company announces dividends and the price of the stock increases, it results in profit sharing of the company to the shareholders. However, if the company remains unprofitable or price declines, the losses are shared with the investors. Corporate governance. Due to the regulatory requirement of the stock exchange, the corporates listed on the stock exchange are bound to follow the rules to disclose the company's performance to the market. Further, as the company has public shareholder, the company needs to provide regular information to the investors for keeping them in confidence. This tends to improve the management standards and efficiency of the company. Opportunity for small investors. Most of the investments, including business, real estate, gold, etc., require significantly high initial capital outlay. However, anyone can invest in stock exchange with as little as rupees 10 and more than rupees 100 crores. Hence, stock exchange provide opportunity for anyone to invest and participate in the growing economy. Investment for large infrastructure projects. Large infrastructure projects by government and private sectors like roads, electricity generation, housing, etc. requires huge investments. The government or corporate can issue fixed income securities called bonds. Hence, this enables government and corporations to borrow money as loans from the public. Economic indicator. The indices of the stock exchange rises with growth of economy. The stable and growing stock exchange reflects good performance of the companies and shows positive sentiments of the economy. The sudden decline in the stock exchange indices reflects the negative sentiments and sometimes recession in the economy. Liquidity and price stability. For any market, the salability and price stability of any goods and services gives confidence to the stakeholders. In the stock exchange, the financial securities are bought and sold on continuous basis with large number of participants. Hence, it provides liquidity to the investors. Further, due to regular transactions of the financial instruments, along with the fair rules and regulations of trade, the price movement remains in the range. Stock market index. The movement of the price in the market or specific section of the market are captured in the price indices are called stock market index. The indices are calculated by weighted market capitalization with the weights reflecting the contribution of the stock in the index. The stocks are included or excluded on a regular basis to reflect the ongoing business environment. In India, Sensex and Nifty are two major indices. Sensex index tracks 30 well-established and financially sound companies listed on Bombay Stock Exchange. On NSE, Nifty index is a market capitalization weighted index for top 50 companies listed on NSE. Perspective on market conditions. The stock exchange can move very fast in either direction. The investors try to catch the trends of market to make profit by trading and gaining from momentum. Following terms are widely talked in the discussion of investors in the stock exchange. Bull market. It is used to describe positive movement of market prices over a period of time. Although prices can fluctuate in between for short duration, but the prices keep increasing over the period under bull market conditions. An investor can be described as bull if he is confident in the positive price movement of the market or stock. A bullish investor can gain by investing in the market and selling the stock at later time after price increase. Bear market. In contrast to the bull market, the bear market describes the negative movement of prices over a period of time. The prices can fluctuate in the short term, but the prices continue to decline over a period of time. The bearish investor can make profit from the price movement by short selling the financial securities, which means selling borrowed shares and then buying to cover when prices fall. Stag investor. The stag investors are those who buy and sell shares in short order to make a profit, such as a day trader. The stag's goal is to profit quickly on a short trend instead of buying and holding for the long run. Lame duck investor. They are bear investors who fail to meet the obligation and struggle financially like lame duck. Generally, a bear investor tries to dispose of certain shares on a specific date after short selling, but sometimes the investor fails to deliver, resulting in heavy losses. Investment strategies. Fundamental analysis. The investment in stock market requires understanding of the financial principles and underlying business of the company. The company performance can be evaluated and its future performance can be predicted based on the company's planning and expected economic conditions. Hence, this allows the investor to speculate on the price movement of the stocks, which can result in significant payoffs. Technical analysis. The investor can study the price movement through the use of charts and quantitative techniques to forecast the trend of the stock price, regardless of the company's profit and loss. Index methods or mutual funds. The non-active investors cannot follow the market continuously on daily basis. Hence, the investor chooses to invest in the index like Sensex or Nifty or infrastructure sector funds where the price follows the trend of group of companies. This strategy allows to maximize diversification, minimize taxes from too frequent trading, and ride the general trend of the stock market. Stop loss. When an investor buys a stock, he expects that the price of the stock will increase, thus resulting in the profit. However, if prediction of future was so easy, then no one would have lost. Hence, sometimes due to wrong estimation of company performance or adverse economic indicators or simply market sentiments, the stock prices decline. It can result in huge losses. Hence, investors try to limit their losses by following stop-loss strategy. The idea is to sell the stock if it declines below a certain price level. Many investors sell the stock if it declines more than 10% of the stock value. Another key concept is trail stop loss. Never turn a winner into a loser. The idea is to raise the bar if stock prices increase by a certain percentage point. Example, if an investor purchased stock at Rs 100 and the stock price increases to Rs 110, then the investor should keep the stop loss price at Rs 100 instead of earlier stop loss price of Rs 90. Hence, no money is lost and the winner stock didn't become a loser. Leverage strategies. Trader can invest in a stock without owning the stock by using short selling and margin buying. Further, a trader can invest in a stock through derivative, providing control over large blocks of stocks for a very amount of money as compared to outright purchase or sales. Short selling. In the short selling process, the trader borrows stock and sells it in the stock market, expecting that the price of the stock will fall. The trader eventually buys back the shares at the changed price, thus resulting in profit if expectation is met or losses in the opposite case. The stocks can be borrowed usually from the brokerage, which hold its client shares or its own shares on account to lead to short sellers. This allows the trader to speculate on the price of the stock without paying the full price of the stock ownership. Margin buying. In the margin buying process, traders borrow money at interest to buy the stock, expecting the prices to increase. The margin contribution, let's assume 50% of investment value contribution, depending on regulation, comes from the trader. If the stock prices increases, the investor can sell the stock, making profit after deducting the interest amount on the borrowed money. However, if the stock prices declines, then the investor is required to put additional margin money to maintain the account's equity. Derivatives. The financial innovation in last few decades has brought new financial instruments whose payoff depends on the movement of prices of stock. Stock options, equity swaps, etc. provides alternative to traditional stock investment. As these products allow the investor to speculate on the prices of underlying assets, it gives an opportunity to the investors to hedge their risk and receive payoffs. Stock market crash. A sharp dip in the prices of equities listed on stock exchange is referred to stock market crash. Fundamentally, the stock market decline is caused by weakening of fundamentals of the macroeconomic conditions. However, the crash is often caused due to loss of confidence in the stock market and panic among the investors, along with the weakening of economic fundamentals. The stock market crash results in multi-billion rupee losses in the stock exchange market capitalization within very short time period. One of the most famous stock market crash happened in 1929, resulting in more than 50% decline in the stock prices. This followed by the Great Depression across the world economy. However, October 29, 1929, Black Tuesday, marked the beginning of the Great Depression. This was the single most devastating financial day in the history of the New York Stock Exchange. Within the first few hours that the stock market was open, prices fell so far as to wipe out all the gains that had been made in the previous year. Since the stock market was viewed as the chief indicator of the American economy, public confidence was shattered. Between October 29 and November 13, when stock prices hit their lowest point, more than $30 billion disappeared from the American economy, comparable to the total amount the United States had spent on its involvement in World War I. Similar market crash happened in 2008 across the world stock exchange market, resulting in destruction of huge wealth for the investors. Stock exchange in the modern economy. With focus on the economic prosperity and globalized trade, the economy has been liberalized. It allows the optimum allocation of resources with less government intervention. In the traditional economy, the savings are deposited either with the banks or government-issued financial securities like post office savings. Although the investments up to certain limits in banks and government deposits are guaranteed, it does not necessarily provide efficient allocation of capital due to government interference and role of bank. In the developed Western economies, there is growing trend of higher proportion of investment from saving in the stock exchange through index, stocks, pension funds, and mutual funds investing. This has historically proven to provide more beneficial return in comparison to returns from banks or post office investment. However, the stock market crashes after every few years caused due to recession keep the investors cautious about stock market investments. Market regulator. Securities and Exchange Board of India, that is SEBI, headquartered in Mumbai, was established in 1988 as non-statutory body. In 1992, it became a statutory body by the SEBI Act passed by the Indian Parliament. The main aim of SEBI is to protect the interest of investors in securities and to promote the development of and to regulate the securities market. As the nodal markets regulator, SEBI has following functions to regulate the business in stock exchange. Frame rules and regulations and a code of conduct to regulate the intermediaries such as merchant bankers, brokers, underwriters, etc. Bring these intermediaries under the regulatory purview to make sure that all the participants in the stock exchange comply with the fair rules of investment. Regulate the working of stockbrokers, sub-brokers, share transfer agents, trustees, merchant bankers, and all those who are associated with stock exchange in any manner. register and regulate the working of mutual funds, etc. Regulate takeover of the companies by issuing guidelines and ensure compliance of rules for takeover and merger of corporations. Conducts inquiries and audit of stock exchanges. In case of any necessary potential problems, SEBI can ask the stock exchange to make necessary changes for improvements. The growth in the transaction volume of stock markets resulted in a lot of malpractices in stock markets such as price rigging, delay in delivery of shares, violation of rules and regulations of stock exchange, and listing requirements. SEBI has played a very important role to check these malpractices and bring confidence to the investors. Further, SEBI has also tried to increase the participation of retail investors in the stock exchange. I hope you like this session. Have a nice day. Take care and goodbye.
Thank you.